Yeah, I mean, we do think there are some reasons to be more optimistic, at least in terms of the sequential path from growth from here. Like clearly, on average for the full year, because of how weak the first quarter could be, the full year growth number may not be so great. But I think as we move through the year, things should start to improve. And the things that make us believe that are, number one, the much more rapid and early start to the China reopening theme. And our economics team there is substantially above consensus in terms of where real GDP comes out in China this year. We have it real GDP at 5.7%, whereas the consensus is still at 4.8. So we're way above the market there. We think that will help global growth and push the dollar down. I mean, ultimately, when you see a strong China, it will benefit large parts of emerging markets. It will benefit Europe. Probably the economy that it benefits the least is the United States. And so this should all be helping the dollar to go down and for EM to do well. We also think that Europe is looking at the margin a little bit better as well. I mean, clearly natural gas prices have really come down very substantially over the past few months. Our commodity strategists have just halved their natural gas forecasts for the year ahead. This may take a little bit of time to feed through into consumer pockets, but ultimately, the story is improving. And I think one of the biggest reasons the euro went down last year was the huge terms of trade shock that came as a result of high energy prices, and that's reversing. So I think the outlook for the euro is also pretty good. So yeah, overall, I think we're a little bit more upbeat than the message that came from the World Bank.
James, a couple of questions then on the US dollar. We've come off from the 114 high roughly on the dollar index. How far are we into that journey, and why can't the dollar just change its stripes, going from a risk-off currency to an all-weather one where we see the risk-on moves benefit the dollar as they have done at points in the past?
Yeah, I mean, the dollar's relationship with risk assets does change over time. I mean, I think clearly it depends on what's going on in the world as to what determines that correlation. I mean, I think right now, a lot of the optimism is coming from places outside of the United States. So if you're having a risk-on backdrop driven by that, then you're more likely to see the dollar go down as capital moves out of the US into some of these better stories that are emerging elsewhere in the world. If it's the US, there's the only game in town, and you're back into a story of American exceptionalism like we've seen many times over the past, then that is an environment which tends to be clearly much more supportive of the dollar and can be correlated, have more positive correlation with equities. So, we think that the story right now is more in the former camp, where actually risk appetite that you see because of better stories elsewhere is one that can help actually the dollar to depreciate. So I think a lot of the data that we're getting out of the US does support this as well. I mean, you're seeing clearly growth momentum weakening. Earnings growth and wage growth is coming down in the US, and that is leading to lower US rates. And that's also eroding the carry advantage that the dollar has maintained for the last few years. I mean, clearly last year, higher US rates and widening interest rate differentials relative to Europe and Japan was a big reason for the dollar strength, and it became a sort of relatively high carry currency, at least within the G10 space. But now that process is unwinding. I mean, European yields are higher, Japanese yields are higher, and on a DXY basis, actually yield differentials are moving quite quickly against the dollar now. So we think the Dixie, I mean, we had a 104 target in our year ahead outlook, but we've reached that very quickly, and we think ultimately we could break below 100 over the next few months. So we do think there's a little bit more juice in this short dollar trade.